Welcome back, everyone. Let's just jump right into today's fast-paced explainer because, honestly, we've got a lot of ground to cover. We're going to unpack the overnight macro news that's completely shaking up global sentiment right now, and then we're heading straight over to the technical desk. We'll map out the exact chart setups for the major currencies and the Indian equity markets for the day ahead. So if you're looking to pin down exactly where those crucial support and resistance levels are before the opening bell, you are absolutely in the right place. Let's get into it.
I want to kick things off with this stark number right here, $80 a barrel. That is the crucial catalyst right now, and it's literally rewriting global market sentiment. Traders are currently pricing in additional Iranian supply, and as those energy risks fade, well, emerging markets are catching a massive relief rally. I mean, it's the oldest emerging market trade in the book, right? Cheaper oil just equals happier markets. And as we'll see in just a minute, this single metric is heavily dictating the setup in India today.
But you might be wondering, why exactly is oil slipping? Well, it all comes back to geopolitics, and a really stark contrast in how one single agreement is being interpreted. So we've got news that a 60-day U.S.-Iran Memorandum of Understanding has been electronically signed ahead of a formal ceremony. But guys, there's a massive fine print dispute going on here. Tehran is saying sanctions relief is part of the package. Meanwhile, Washington explicitly denies any relief is coming, and Israel, they're insisting this pact absolutely does not apply to their ongoing actions. So while diplomatic momentum is definitely improved, the fine print seems to have been written in disappearing ink.
And that brings us to what I can only describe as a giant game of geopolitical whack-a-mole. Because as Phase 1 of this agreement wraps up, Phase 2 kicks in, and it hinges entirely on the Lebanon file. Iran has basically linked this broader deal to an Israeli withdrawal from southern Lebanon, a condition that Israeli officials have publicly flat-out rejected. Now, we do have fresh talks between Israel and Lebanon on the calendar for next week, but honestly, as soon as one risk slightly fades, another pops up. The G7 has suddenly pivoted its attention back to Russia, discussing even tougher energy sanctions. It's just this constant rotation of risks that's keeping markets on high alert as we head into the European session.
And this perfectly captures the stubborn reality of the global economy right now. We are looking at total diversions. Take China, retail sales there are actually contracting. So the factories are busy, sure, but consumers? They're elusive, leaving Beijing heavily reliant on exports. Then you move over to the US, where higher interest rates are finally biting hard. They're effectively freezing construction activity as housing starts to take a really sharp decline. But then, right in the middle of all this sluggish consumer data, Europe suddenly delivers these surprisingly upbeat ZEW sentiment readings. I mean, the data is just completely fractured, depending on exactly where you look on the map.
So the trick is knowing exactly what data you need to watch today. Here's your macro watch list. First up, we've got UK CPI and PPI data dropping, which is going to be absolutely vital for the Bank of England. We've also got Eurozone CPI and comments coming from ECB President Lagarde, which, by the way, is really going to test that newfound European optimism we just talked about. Add in US retail sales, housing, and crude inventory data. But listen, make no mistake, the absolute main event is tonight. Kevin Warsh delivering his very first FOMC policy decision and the accompanying statement. Everything else today, it's just a preamble to that.
All right, let's transition over to the technical desk and see how all this is actually playing out, starting with the US dollar index. The main catalyst for the DXY right now is the bond market. We've seen the US 10-year Treasury yield slip from 4.47% down to 4.44%, and the 2-year has eased back to 4.05%. What this tells us is that Treasury markets are pricing in a near certain Fed hold tonight, keeping rates at 3.50% to 3.75%. Because of that, traders are shifting their focus entirely away from any rate action and moving strictly toward Kevin Warsh's messaging. Add in those improving geopolitical sentiments, and that's exactly why we're seeing the DXY slip.
So let's map out those DXY technicals. Tactically speaking, the prior buy-on-dip structure we've seen has really lost its momentum. If you're actively trading this, your immediate ceiling is sitting right at 99.64 before you hit that massive key resistance up at 100.25. Now looking to the downside, keep your eyes peeled on 99.16 and 99.00. But truly, at the end of the day, all eyes are on the Fed tonight to dictate the next real directional move here.
Okay, moving over to the euro. We've actually seen a bit of an upward break here. As the dollar pulled back, the euro-USD pair pushed up above the 1.1612 resistance level. And this move? It was largely fueled by those surprisingly upbeat ZEW prints we highlighted a minute ago. But the real question traders are asking today is, was that upbeat data just a mirage? We're going to find out for sure very shortly when those critical Eurozone CPI prints drop and President Lagarde takes the mic.
So what exact levels should you be watching? Immediate moving average resistances are grouped pretty tightly between 1.1634 and 1.1650, with a bit more resistance sitting just above at 1.1656. Now, if the pair drops back below that 1.1612 mark, your support zone kicks in between 1.1588 and 1.1521. Tactically, our view here is simply to wait. You've got the European CPI numbers hitting today, which will be interesting for sure, but that Fed meeting tonight is the absolute next massive mover for this pair.
Now let's check in on the British pound. Cable is actually doing slightly better than the rest of the majors right now. The market is really setting up for tomorrow's Bank of England rate decision. But here's the thing, traders aren't necessarily expecting rate action. Instead, they are laser focused on the forward guidance and the MPC vote split. That's the real signal right there. Also, definitely keep an eye on today's UK CPI and PPI numbers. The markets might be expecting an uptick, but remember, UK CPI has quite the history of delivering downside surprises. Because of all those looming events, the technical setup for GBP/USD is really tightly sandwiched right now. You've got support holding firm at 1.3393 and immediate resistance capping things at 1.3450 right before the pivot at 1.3534. Because it's stuck in this super tight channel, the tactical view is crystal clear. This is strictly a no-trade zone for the moment, at least until we get a clean break in one direction or the other.
Okay, I absolutely have to highlight this historic anomaly out of Japan, 1%. The Bank of Japan actually hiked its benchmark rate to 1% for the first time since 1995. I mean, you would normally expect fireworks on the charts for a massive milestone like that, but what did the markets do? Literally nothing. They remained completely indifferent.
And that indifference is crystal clear when you map out the UST/JPY technicals. The yen has been completely stuck in this tight trading range for the past week. To see any real action, we need a solid break outside of it. Resistance is sitting at 160.55, and if we push through that, it opens up a target of 161.94. On the flip side, support is down at 159.77, and a break there targets 159.25. However, the big picture structure? It remains a solid buy on dips. Japanese trade numbers just beat expectations yet again, which is really helping keep this broader trend completely intact.
Let's pivot over to the Indian markets and see how this all builds a completely different narrative. I've actually been calling this India's oil-funded holiday. Falling crude prices are essentially doing what the recent earnings season just couldn't. They are putting investors in a fantastic mood. As those energy risks we talked about at the top of the explainer fade away, inflation worries are cooling right down, bringing the 10-year bond yield down to 6.87%. Foreign inflows are looking up, and India is right in the middle of a classic emerging market relief rally.
And we're seeing this relief rally get highly concentrated. Lower crude prices were a direct injection of domestic confidence yesterday. We saw Nifty Realty jump 2.3% as real estate confidence surged. Nifty IT outperformed too, climbing 1.8% as the market started pricing in a serious boost to tech capital expenditure. This kind of sector outperformance perfectly anchors the narrative that, yeah, cheaper oil is acting as a very real, direct stimulus for Indian equities right now. Looking at the currency side for India, the rupee just booked its third consecutive session of strength. It closed up at 94.56 against the dollar, really riding that wave of supportive underlying sentiment and those US-Iran deal headlines. Technically speaking, it just logged another close below the weekly pivot of 94.77. Because of this, the USD-INR pair is now looking like a high-conviction sell on rise. Your immediate floor is at 94.51, and hey, if that gives way, the trapdoor swings wide open all the way down to 94.06. On the upside, you'll want to use 94.77 and 94.92 as your key resistances to sell against.
Finally, let's lock in those Nifty 50 levels. The index extended its winning streak for a third session, closing higher at 23,989 and successfully reclaiming that crucial 24,000 neighborhood after what was a pretty soft weekly expiry. The technical structure here remains a definitive buy on dips. For today's session, the absolute critical support level that simply has to hold is 23,900. If the bulls can't defend that line, the trapdoor opens to 23,698. But as long as that 23,900 support holds firm, the upside target the market is aggressively eyeing right now is 24,344.
So after a week that has been completely dominated by geopolitical headlines and shifting diplomatic agreements, it leaves us with this final thought. With Kevin Warsh stepping up to the plate for his first FOMC policy decision tonight, will central bank data finally get a chance to dictate market direction, or is the sheer unpredictable nature of geopolitics just going to keep stealing the microphone?
Keep a close eye on the charts, watch those key levels, and we will see exactly how the market decides to answer that question. Catch you guys next time.